Disclaimer. This material in this presentation has been prepared by ADCM, LLC DBA Willow, and is general background information about Willow's activities, current as at the date of this presentation. This information is given in summary form and does not purport to be complete. Information in this presentation should not be considered as advice, or recommendation to investors or potential investors, in relation to holding, purchasing or selling securities or other financial products, or instruments. Neither the information nor any opinion expressed herein constitutes an offer or a solicitation of an offer to buy or sell securities. Before acting on any information, you should seek independent financial advice. All securities and financial products involve risks. While due care has been used in preparation of this presentation, the information contained herein has been obtained from sources believed to be reliable, but its accuracy and completeness cannot be guaranteed. Forecasts and hypothetical examples are subject to uncertainty and contingencies outside of Willow's control. Past performance is not a reliable indicator of future performance.
Welcome, everybody. This is our January market update. We're going to be covering some of Alexander and I's thoughts on what we're seeing out there in the economy and in markets, and then also go into what we're seeing in the digital asset crypto space too. So bear with me while I share my screen. Okay.
See our new logo for crypto.
Hey.
Nice job. Okay.
Okay.
All right, let's roll.
Here we go.
Okay. All right. Risk indicators. So you can see here, we have a slow rise in risk indicators, a little bit of an increase over the last month. If you know if you recall, this is our proprietary volatility index. It takes into account how many variables, Paul, do we
14 different measures of volatility.
Okay, 14, yeah. We put this in
equity markets, bond markets, and international emerging markets. A whole bunch of different ways to look at, how crazy our market's getting.
Yeah, and this is really has more to do with, more to do with like credit risk than anything else, like a risk of the economy rolling over, I would say. All right, let's go forward.
All right.
CDS
These
spreads.
are our
ahead,
default swap spreads, and these are also sort of like insurance on against whether a company is going to go bankrupt or not. Like, what are the chances if a corporation is going to default on its debt? And when you see these spreads start to rise, it says that the insurance against that starts to get more expensive, which is saying that somewhere along the line, someone is perceiving higher risk in those corporations or investments, that the chance of them defaulting is slightly increasing. And so while it's nothing major, we have noticed that these have been slightly ticking up over the past few months. Something we want to keep an eye on.
Yes, of course. And bad spreads. So let's see, Paul, what the red line, I'm just looking here.
Yeah,
is that
it's a slow, as interest rates have changed over the past, the Fed came out, said they're going to raise rates. There's been some movements in bond markets. These spreads have slightly widened, but again, nothing crazy right now, but it's more the direction and the momentum. So one of the things we always look at is the velocity of how these lines change. And so when we start to see them steepening a bit, to us, that signals something to pay attention to, that there could be some concerns under the hood of the market.
I think maybe next time what we might do is actually show retrospectively for you all to see what it was like during the financial crisis, so you have a frame of reference. We'll do that next month. So, okay, so let's see. Velocity of money. Oh my goodness. Okay. Yeah, so you can see that, just so you know, the velocity of money for us is very important because the velocity of money gives us an idea of how much people are spending, the effect of money supply in the system. And you can see that even though money supply has increased, the velocity is going down. That is not good. That is not a good trend. And so Paul, you circled something back here. What was that?
That came with this chart.
Okay. So, usually you want to see the velocity increase. If the velocity starts to slow, it does show that we may be heading towards recession. So anything you want to add to this, Paul?
Yeah, just that when velocity slows, dollars are being hoarded instead of spent.
Yeah.
And now there was something like, I forget the exact number, $6 trillion or something that was recently injected into markets post-COVID. And that money needs to go somewhere. And so a lot of people, a lot of corporations, banks, it's not freely flowing through markets according to this metric anyways.
Yep. Okay. Next. And the CPI number, I mean, I think it's misleading. Obviously, it's 2020, but we can go into that at a later point. Oh my goodness, here's our deficit. So, one of the biggest concerns coming out of the financial crisis, or really since, if you look back at interest rates, you see interest rates over the last 30 years have been just going steadily down. And in the process, like in the financial crisis, in the tech boom, and after the tech boom, when we went into a bust, you saw that there was more and more debt switching from private to public sector. So the governments now have more debt than we've had. So you can see our deficit is way, significant. This is inflationary. This alone, to come out of something like this, is, in order to be able to come out of this, it is just in and of itself inflationary. So we feel we're in a zero-sum game here. We've been playing, I think, Russian roulette for a very long period of time and kicking the can down the road instead of fixing some of the fundamental issues we had with the economy. Our government's just been taking on more debt and, spending, overspending. So somebody has to go in and balance this at some point. And if they don't, we're just going to see it by way of higher inflation. Anything to add there, Paul?
Just that the higher, or I guess the deeper that this line goes, the worse it gets, the more it increases the chances for instability.
Yeah. No question. Yeah. And something to know, what is our economy? What, Paul, 13 trillion, 14, 15 trillion. So our debt is equal to our GDP right now. That's crazy. That's just bad. Yeah. So we, in the face of the Fed raising interest rates with this situation, it's, I think, could spell some problems down the pike. Okay.
Right. Margin.
Yeah. Okay. So one of the things that in this industry, and for those of you who might know, but when margin debt begins to track much higher, we usually begins to spell the end of a bull market. So when we get to a point where margin debt is just significant, and you can see these lines here, .com, pre-financial crisis, and the pandemic. You can see that. So there's been more speculation in the market, and therefore more institutions and individuals taking on debt. And that usually spells, for us, the end of a bull market.
Right.
So,
and just to add, part of this is a function of policy, where interest rates have been so low that there's been nothing stopping, these companies from just saying, hey, interest rates are basically zero, so we're just going to keep borrowing and borrowing and borrowing. At some point, that catches up.
And one of the things that, sadly but true, what happens towards the end of this cycle, so you have institutions and you have retail. So institutions obviously are corporations and such, and institutions such as ours, and then you have retail, which is the individual. Sadly, at the end of this process, usually what you see is this huge thrust of retail actually taking on debt to margin their securities. So and usually that's where the retail individual gets their hands stuck in the cookie jar, so to speak, when things begin to unravel.
Yeah, I think it pairs nicely with this chart too, Alexander. You were talking with me last week, actually, about or earlier this week, about 7-year cycles, market cycles.
Yeah.
And they sort of also line up pretty closely with the peaks of this chart every 7 years. The one that's missing is like the 2014, 2015, but that was averted due to government action at the time.
Huge government and preemptive action, huge. Thank you, Paul, for bringing that up, because this would be a good place to actually talk about it. Paul was talking about, one of the things I mentioned to him, and he's seeing, because Paul obviously uses both hemispheres of his brain, so he gets it. So we had the first crash in 1987, right? So that affected all markets. And then in 1994, it wasn't a significant crash, but for the first time in many decades, you saw a negative bond market and a negative stock market. And we were in a recession in 1994. And then you fast forward to 2001, 7 years later, you know what happened then. And then you fast forward to 2008, you know what happened then, financial crisis. Then you go to 2014. And honestly, if you looked at the markets in 2014, there was some technical unraveling. There was definitely some technical unraveling, but the government, and Paul, was that when we were close to breaking the buck on the dollar, on
It was right when
money
all that
markets?
all that
Okay,
talk
that's what I thought.
was going,
Yeah. So we were,
yeah.
the Fed had to step in overnight to actually flood the system, because there was a bit of a liquidity crisis that wasn't in the newspaper, wasn't in the mainstream. So they diverted difficulty. So really from there, now you fast forward to 2022, we're again in that 7-year cycle. So, and this time we do think that there will be an unravel, but we'll get into that in a moment. Inflation. Okay. So for those of you who listened, we were going to put our video clip in from October, but if you remember, I said inflation is not transitory, period. And the Fed is wrong. At that time, if you remember, Wall Street was saying it was transitory. The Fed was saying it was transitory. We are saying it is not transitory. We are holding on to that. There's a number of reasons for it. Number one, we have supply issues. This is not just due to COVID. Yes, we have interruption due to COVID, but you also know there is tension. There is tension around the globe right now with the governments, and this is a problem. This is destabilizing. Then on top of that, I don't know if all of you have been reading this, but we have more hijackings of our trucks with supplies on them in this country. I don't know if you've been reading about this, but this is actually happening, not just trucks, but also trains. So what does that say? It's destabilizing, not just internationally, but even domestically. So if you're contracting supply and you still have demand, you have inflationary pressure. The other thing is, Paul and I have been talking about, we really do think the United States has lost some of its control with OPEC. And we do see oil energy prices going higher. This past weekend, we saw in New England, what was it, Paul, 400 or 500% increase?
500%. 500%
increase in electric rates this past weekend. Now, I don't know about you.
Year over year.
But year over year, this is no different of a cold year than any other year we've had. In fact, all the way up until recently, it's been unseasonably warm and not really too cold until a couple of weeks ago. So one of the things that worries, which I don't even like to talk about inflation, because it becomes a self-fulfilling prophecy. And we do think that this is starting to happen. So we do think that companies are taking advantage, period. I will say it. Companies are taking advantage of this situation. In addition, you have destabilization that's creating supply issues. Number one, COVID. Number two, whatever's going on in the psychology of people. I think we're all starting to feel that tension building, not just domestically, but internationally. Those are not stable. And that is why our thesis, and Paul, add anything you want here, is that inflation isn't transitory. Do you have something to add?
Yeah, there's all those pressures behind the scenes, and it almost seems too that the toolkits that regulate, the kind of facade of the Fed, the toolkits that regulators have, they've pretty much kicked the can and exhausted most of the things. What are they going to do? Keep injecting money into the economy? Well, that's probably going to continue to drive prices up. With a flood of new money, prices will go up. Or are they going to continue to increase interest rates, which tanks the market?
Yeah.
potential, or has the potential to anyways.
No,
Or,
no, I mean, let's just say it like it is, because
Yeah.
we are seeing some deterioration, right? So,
Right.
yeah. It's so to Paul's point, they are in a bit of a quandary, right? So we know they have to fight this inflation. However, I'm not so sure that the tools that the Fed has, as Paul said, are going to be able to fight this inflation, because this is a bit different than just high demand. This has got a lot to do with some instability that we have. In addition, have they exhausted all of their resources? So it's a question of whether they're going to combat inflation, push us into a recession, which there's signs that we're going there. Okay. We talked about this in October. There's signs. And Paul and I have been raising cash, even though the market hit a new high in 2021 towards the end of the year. We have been raising cash in the portfolios since November, right? Beginning in November. Yep. Because underneath the surface, you guys, we are seeing a deterioration. If you look at the S&P 500, you can see the majority of the 500 stocks, the majority have been going down. If we can actually pull in some of the charts, we can show you that. So what we're saying today is we are definitely seeing signs that the bull market has run its course. There are signs that, right now the Fed is going to have to make a choice: inflation or recession. There's some proof by the way the market is trading that we are already. So if you look at the stocks that are performing well, or the sectors that are performing well in the industries, it's the ones that do better in a recession and the ones that do better in high inflation. All the rest, the growth, like the technology, some of the higher growth, they are literally falling apart. Right, Paul? I mean, what's holding in there? Maybe one or two
companies,
stocks.
You look at a company like down 40 to 60% or something, maybe even more than that now from its high already. A bunch of these high flyers from before have just been punished over the past few months. While the other more defensive certain cyclical sectors are actually look extremely well positioned. Yeah. And so I want to bring it back to what does this all mean for how we're approaching allocating the portfolios. As Alexander said, we've been raising cash. We have a nice cash cushion across the board for the vast majority of our portfolios. We are looking at more defensive positions. We've added some certain sectors over the past few weeks, very selectively here and there, to provide some exposure to the energy sector or certain utility sectors. And we're looking at a few other areas to deploy some cash to. But right now, all the indicators and the risk metrics, these things that we're watching very closely, they're warranting caution.
Yeah. And so let me get back to what Paul said. So one of the things that I know, having been in this industry 34 years, is there's always an opportunity somewhere, because money has to go somewhere, right? So one of the things, so Paul's saying that we're looking at certain sectors. Well, what are those sectors? Energy. So mid-year last year, we bought energy for you. In fact, one of our clients asked why we bought an ETF called XOP, which is the drillers and such, because we see this trend toward higher prices. So therefore, there will be more drilling and such. So anyway, so their utilities is the other area, and like food and staples, those are the other area. But there are times, and this is really important, so you have to be patient with us right now. There are times where it's better. I know the market's bouncing today, okay? And I think maybe next week we can do another review for you that actually shows you the S&P 500. Actually, maybe I can show that today, so you can see what we're seeing. So you can see the breakdown. Okay. And there are times where it's just better to be in cash while we're assessing the situation. We actually have the ability to buy some ETFs that can short, like give a little bit of cushion to the portfolio. So if things go down, we could make a little bit of money, but that would be something we would trade. We would not be holding that long term. There are things, but we are at this point where we have to look at everything and determine where best to be. So for us right now, we want safety. We want things that we know are value oriented and tend to do okay if we do roll into a recession, which the markets are the number one leading indicator. Markets and interest rates, two best leading indicators. The markets are showing us we are rolling into a recession. So
yeah,
anyway,
to Alexander's point there, our priority is to protect your money. We want to grow it, but really at the end of the day, it comes down to we want to protect it.
Yeah, and we think, and here's the bottom line too. I mean, I think 2022 is going to be a challenge for a number of reasons. We have power struggles taking place everywhere. Let's face it, leadership in the United States is questionable at this time. And that is concerning. And that leaves us vulnerable.
Comes back to the point we've mentioned several times about social cohesion, and just as the less cohesive society can be, and the more divided and argumentative people get, and the less willing they are to compromise, the more uncertainty it introduces, which markets hate.
Yes. So here's my pitch. Don't do it. Don't get into an argument with anybody about their views. Just love them, because separation right now could create some serious problems for us. So let's just, whoever has a different viewpoint, that's fine. Just let's find a way to be together, because honestly, as I sit here having done this for so many years, and Paul feels it too viscerally, something isn't right in the world right now. Something isn't right. There's so much separation and so much friction among all of us. And it's destabilizing. So if I could just please say, try not to roll into the fear. Try not, because that's what makes you make decisions that are not of sound mind. So I don't mean to say we have ice water running through our veins, but to a certain degree, we have to become very objective to what's in front of us. And I refuse to fall into any type of friction with anyone. I won't do it. And
we're all on the same team.
We are all on the same team. Team humanity, please. So anyway, this is going beyond investments, but it's really not, because psychology, the state of the human mind, the state of the human heart, the state of fear versus, let's call it love, because they say they're two bipolar, the two most, you can either be in fear or in love. That state matters. It matters, because if we are in fear, fear is just going to create more issues. And so, to be honest with you, this is equally as important to Paul and I in our assessment of where we're headed next as these data points and these numbers. So anyway, that's our little spiel. Let's see what's next, Paul. I don't know what we have next.
All right.
Here.
That sort of rounds off our current commentary on market.
So let me wrap that piece up before we go to crypto then. Okay. So bottom line is this. We are taking a much more conservative posture. We feel like, please be patient with us as we try to figure out what's happening here. We think we have a pretty good idea of what's coming. I don't particularly like it, having been in this industry for a very long period of time and seeing how things unravel. We are at that 7-year cycle point, which to us is an inflection point. So again, I'm going to reiterate something Paul and I talked about in September. What keeps us up at night? 1, consolidation of power to the top, which you're not only seeing with corporations, but you're seeing with, money consolidating to the few. You are seeing governmental issues, okay, big power struggles, and that's destabilizing. Okay, that's one. The second thing is this inflation. The inflation, supply issues, that's next. And then obviously credit debt is a big issue too. And then of course, how that all plays out to how people feel, to the potential of more civil unrest, which we already know. So that in a nutshell has us saying we have to be conservative, and please don't get into the argument with other people. Like, do your best to just accept where somebody's viewpoint comes from and just walk away and just love them anyway, because I think this could really create problems down the pike. Okay. Anyway, so next, Paul.
All right. So
crypto.
pivot gears here a little bit.
Yeah.
And move into just a quick update on the crypto side. This is a very interesting chart that shows sort of, I'm going to go through a couple different charts of some really interesting high level things, and then get a little philosophical on crypto for a second, and then we'll open up the floor to questions just to give
sorry we're going on today, but we feel it's important.
This is just shows a whole bunch of different blockchains and apps built on different blockchains, what their current revenues look like over the past 365 days. You can see this huge green candle here is Ethereum, clocking in $6 billion in revenues over the last year.
6 billion.
The next one in line is a game called Axie Infinity, which generated $1.3 billion in revenue. You keep going down the line, and way over here, you can see something like Solana, another highly hyped blockchain. It's only generated about $14 million.
Only 14 million.
only, right? Right. So needless to say, the space is growing.
So this is revenue. So you understand, this isn't like, trading revenue. No, this is revenue. This is actually
basically the way to think about revenues is people paying for block space, people paying to use these networks. So if you want to transact on these networks or send data or interact with a contract or a game or DeFi or an NFT or any of that kind of stuff, there's transaction fees that you have to pay.
DeFi, decentralized finance.
That's essentially the revenue, right? So it just shows that demand for block space is increasing.
Yep.
It's turning into a revenue generator.
Okay. Decentralized finance again. Okay. So, it's circumventing the banks as a way to get lending and so on. Okay. So that's what decentralized. So this is all happening. This is real revenue that's taking place. Okay. I mean, that's not a small number.
Yeah. To put it in perspective too, on the left here, this is how much revenue Visa made, the entirety of Visa, right? And credit card processing, all the other business at 24 billion, with Ethereum right behind it, more than Stripe, a massive global payments network. So it just shows these things are growing, they are coming for a lot of the traditional.
I find it really interesting.
Financing space.
Yeah, I find it interesting. We'll call some attention to where Bitcoin is versus where Ethereum. Remember, Ethereum is one of the things that Paul and I like about cryptocurrency, in the digital space, is the infrastructure. And that's what Ethereum is, infrastructure.
Yeah. Right. You think of the Ethereum platforms like the App Store, like the Apple App Store, except instead of just apps, you can build entire organizations on top of it. Exactly. We can get into that later if you want. Exactly. So one of the major themes happening, and I believe that in 2022, we'll see a lot more of this. You'll hear a lot more talk around the creator economy. And the idea is that in the Web 2.0 world, or sort of our traditional world where there's the Twitters and the Facebooks out there, a content creator doesn't really own their digital property. They're renting space from Facebook or from YouTube, and they're given maybe a small portion of advertising or revenue fees. And then it's really up to them to hustle or create their own products. One of the major differences in the Web3 space is that you can actually own all your stuff. You can own from top to bottom, the distribution, the actual content, the you can capture your eyes and then monetize them and own them in a much, much fairer way or much more equitable way than current infrastructure is set up for.
So this is a game changer for musicians, for artists. This is a game changer for them.
And this chart that shows, when looking just at the creator economy, this is only looking at Ethereum, but built on Ethereum, I mean, it's comparable to Etsy, the amount of revenue that Etsy generates, and YouTube Music. And then Spotify's over here, only 2 billion more, but slowly, catching up. So it's worth paying attention.
It's I just have to say, so for me, this is just fun because, our thesis long before it started creating revenue is that this is what we were going to begin to see, and it's happening. So it's pretty cool.
And then this is a metric called total value locked.
Oh, Paul, can we just back up for one moment?
Oh, yeah.
We have a question. Could you, since we're still on the conversation around revenue, could we describe the revenue process?
Sure.
So let's do that.
There's multiple different ways that revenue can be generated on these platforms. The first and most basic way is that if I'm going to send a transaction from me to you, or from Bob to Alice, in order for that transaction to be sent, a small portion of it goes to pay. It's called like a gas fee, to pay for the economic security so that transaction actually happens. In order to pay the network for your block space, your transaction that's on the block to move from A to B, there's a small fee that the network itself takes. Okay, that's the base generation of revenues for any blockchain. Okay, on top of that, you can have different apps or protocols that use the blockchain to send their transactions, to settle, to make sure everything works. And those apps and platforms can charge their own fees on top of that. So you can have a few different layers of revenue generation that way. But at the base of it, these platforms, you're paying for security. So because it's a globally distributed thing, and there's potentially tens of thousands of people all around the world who are running hardware or software to uphold the ledger, or to make sure that it is credible and valid, they all are incentivized by earning a portion of those fees. And so that's how this network sustains itself.
Great.
Hopefully that.
Yeah, that was great. I think that was great. Okay.
Could you give an example of a typical platform use? So,
yeah.
Well, for example, Bitcoin is probably the simplest, right? If I send my Bitcoin to you, I am basically signing a message. I am sending my cryptocurrency on my Bitcoin address to your Bitcoin address. In order for the network to process all of that, it goes through the whole mining, Bitcoin mining piece, where the miners are hashing these different values to make sure, like, okay, everybody has the same copy. Everybody can, or 51% of the network can confirm that, yes, Paul sent X Bitcoin to, whoever else, to Alexandra, and a portion of that is extracted as a fee that is paid to the miners, right?
Exactly.
For that security. So that's like
so easy to send too. Oh my gosh.
Mm-hmm.
I paid for things with Bitcoin. It's so simple.
And then it can get exponentially more complicated when you bring smart contracts in and have all the different nuances of that, which have their own ways to extract fees, or
which is really.
But the basis of it is that revenue is generated at the platform level through fees to use the network, which helps provide economic security for that platform. And it incentivizes the miners or stakers to do that, so that there's a reason, right? I'm not just going to mine or use my electricity or my computer resources if I don't get paid, right?
Yeah, awesome.
All right. And then to touch on DeFi, or decentralized finance, this is a whole slew of different protocols, different smart contracts and code that have been written to essentially replace many of the current financial infrastructure pieces. So things from lending markets to derivatives to indices to all these different things. There's all these different ways that people have said, hey, here's how we can potentially cut out the middleman and then create a way that I can take a loan out against my own funds by locking them into a contract and then, spending the proceeds how I want, or I can lend it to somebody else and not have to pay a middleman for that service in exchange for, whatever the terms of your lending agreement might be. I thought this was interesting to put it in comparison. $153 billion is locked in these contracts. Now, this is separate from how much money is actually in or locked on like a Ethereum staking or those. This is like in addition to that. But you look at something like the Robinhood platform, right? The broker, they only have about $80 billion on their platform. So DeFi is almost twice the size of that, which is, and it just shows the steady growth up, well, a little volatile, but continues up and to the right. So we expect that to continue.
Let's keep going, Paul, then we'll answer the question.
Yeah, this is the last slide. So,
Okay.
there's
that's
lots more to touch on. So I can always get into that further with anyone if you want to reach out or shoot me an email. But here's a good question. It says, since this talks about the volatility of Bitcoin, right? Since its value changes so much day to day, like how would you use it as a currency or to pay for something? And what we're finding in this entire industry is the move to these things called stable coins, where instead of using a token like Bitcoin or something that's extremely volatile in its nature, you can transact stable coins on top of these networks instead, which are pegged one-to-one to an underlying asset, such as the US dollar. There's stable euro coins, and then there's algorithmic stable coins that are sort of tied to different digital assets. All sorts of different ways to do it. Most of the payment stuff that's happening now has shifted over to those kind of models because exactly as this question points out, when you have an asset that's price is extremely volatile, it's really hard to make any payments with it. So you can use stable coins instead to do that and still get the same economic guarantees and security that these networks provide.
So I'm going to go to some of the questions that were sent to us earlier. So the first one is the start of the year has shown lots of headwinds. I think we've already answered this, whether it's inflation, labor, or supply problems, or the end of government stimulus. In 2022, a year when we see equities in general cooling off, and this is why you have been recently building cash in positions. The answer to that is yes, definitely. Okay. Do you feel that emerging markets are being notoriously underinvested? Definitely. I think, there's a lot of growth. I mean, if you look at the value of the US market versus the emerging markets and the fact that we're only what less than 30% now of global GDP, and yet our performance and our market capitalization is so much greater than the emerging markets. So yes.
Correct me if I'm wrong here, but emerging markets too are very dependent upon energy prices and how the energy markets are performing. So when energy gets more expensive, it can also negatively impact emerging markets.
This is true. This is definitely true. I wonder though in the next cycle. Yeah. I wonder in the next cycle, because a lot of them have put I don't know the answer to this, Paul. A lot of them put a lot of money into renewables.
Right. So, this is historic. And as we move forward in the future, these kind of cycles could absolutely change. Definitely something to watch.
But definitely it's a very undervalued place. So it may be something at some point we say we want to look at, but you have to keep in mind right now, like, for example, the largest emerging economy is China, and they are having their own share of economic woes as some of their real estate is unraveling. So, we don't want to be there yet. Too early. Where do you see the greatest risk and opportunities in the year ahead? So I would say the greatest risk, if we're really honest, is civil instability. I would say government instability across the globe. I don't like that. I think that's, if we're really honest, that would be the biggest risk I think we see. Paul, what would you say? And inflation, of course, and
Yeah,
supply
definitely.
disruption. Mhm.
Definitely. It seems almost like a lack of global leadership. One thing that I think is very interesting is that this decade is really set where there's this monumental shift in a generational transfer. And when these things sort of happen, where you have one generation sort of not aging out, but aging, and then a younger or a different generation, younger generation who has a very different set of ideas on what's important, and then everybody grabbing for power creates more instability.
Mhm.
So, there could be very good ways that could play out, that could really lead to really positive innovation, really good things for environmental outcomes and social outcomes. But we'll see. I mean, right now it looks like it might be going the other direction, but definitely a concern.
Yeah. And then we have this other question, Paul. Hold on. Okay. In an unpredictable world, do you bet on using cash positions to invest in growth stocks? Not now. So growth is falling out of style. I think what I want to do is, I think we just have a couple moments, and I just want to share my charts, if I can, really quickly, to show you what is happening to growth. So you can see this is Zoom. You can see, look at this downtrend. It started in the middle of the year last year. These are some of the higher flyers. This is what they call trade desk. You can see here that this has just been a sideways move. I want to get into some of these other ones. Let me see if I can do. So the largest companies have been holding in there really well. Okay. But if you begin to look at some of these, hold on, let's get to DocuSign, Zoom. Paul, give me some other names. I just have to remember. Oh, PayPal. Give me some names here. Visa. Okay. And this is, like, look at this is over, like, you can see the market hit new highs last year, right? The end of the year, but these things have just been growth has just been breaking down. Give me some other
Look
names.
at even Facebook, down in flats.
Oh, Facebook. Yep. Yep. Facebook. You can see just, general downtrend here. Let's see.
Even Amazon.
Trip, Twitter,
nothing.
Amazon sideways. Okay. We don't want anything to do with that right now. eBay, Expedia. Let's see. So if you look generally, most growth stocks, except for few, have been breaking down. And even as we go into this year, you can see, the few now are starting to show some chinks in the armor. So growth right now, not so much. But if you look at value, okay, Exxon, Chevron, even XOP. I think the person who asked this question asked me about XOP. You can see it's hitting a new high. Even like, Altria, you can see is on an uptrend. So all the value oriented stuff, financials, Comerica. So the value oriented stuff are in that direction, and we have a lot of these. So, we really switched more to value as the year progressed last year. Any other questions? UPS, Ford, Gold. Ford is a value stock, fine. Gold, we really don't favor it right now. UPS.
Chart's pretty flat.
I wouldn't buy UPS because if demand comes down, this would not be, it's a growth oriented company.
All right. Well, I think that about wraps things up. So again, anybody has any additional questions, or if you'd like a meeting, please reach out, shoot us an email, or give us a call.
Please give us your feedback too, because we know we threw a lot on you here.
Yeah.
Sorry, but we really want to be very honest about what we're seeing. That's why you have us. So please, if you do have questions, please let us know. Know that we do have ice water running through our veins. So all Paul and I want to do is find a way to outperform you know, if whatever that might mean, if that means we have to become more conservative and keep you protected from a downtrend, or shift the portfolio so we can benefit from some of the trends that are taking place, that's really where our thinking is right now.
All
So
right.
thank you everyone so much. And okay, we did get one comment. All right. Anyway, take care, everyone. And we, you know, hope that you go through life with a lot of peace. Okay. Don't be afraid. Life
For
is
those
good.
of you
We
in
can
the Northeast, stay warm.
stay warm. Okay, everyone. Be well.
All
Take
right.
care. Bye.